Okay, hello everyone. Let's get started here. Thanks for joining us in this free seminar and educational stream. The format of this is just basically going to be a presentation, followed by a private Q&A and hands-on with TradeAtEase members in the TAE Discord. If you like this educational material and want to learn more, consider subscribing. There's a link for 33% off your first month in the description. But if not, no worries. Just sit back, relax, and enjoy some of the knowledge that we're about to drop. So today we're going to go over what's called a market profile. It's one of my favorite tools for understanding the market and market structure. Honestly, learning about the market profile and the idea behind it was one of the biggest benefits to my trading journey, as it helped me understand some of the deeper principles driving the market. In today's talk, we're primarily going to be going over the E-mini S&P 500 futures market, otherwise known as ES in our examples. However, I really want to emphasize that the market profile is not just for futures markets. While the nice even tick size in ES makes it easy to chart, you can use the market profile on SPX or really any stock or instrument that you would otherwise chart with candlesticks. What's most important is the new ideas we're going to be learning today. Then, you can use your understanding of market structure to enhance your edge on your preferred instrument. So let's start off with something that we're all familiar with, the candlestick chart. The wicks of the candles represent the high and low prices of the period, and the two narrow ends of the rectangles on the candle indicate the opening and closing prices. A green candle represents one where the closing price was higher than the opening one, and a red the opposite. Many of us like to analyze candlestick charts for patterns in the market. We may look for things like bottoming tails, bear flags, or double tops. And these are all really popular patterns that a lot of candlestick and technical traders like to look for and then trade off of. However, the downside to the candlestick is that it gives us very incomplete information about the market. Primarily, it forces us to really over-index on price, which is not where our focus should be. Instead of looking just at price over time, let's try to think about the market as a two-way auction process. But in order to really understand the mechanics behind a two-way auction, let's first start with an even more simple example, a one-way auction that many of us might be familiar with, such as an art auction at an auction house. So in an art auction like this, we typically have an auctioneer quoting prices to see who will pay the most. At first, they might start bidding at very high prices where there isn't much interest. Say the auctioneer starts the bidding at $100,000 for a painting. Then they might slowly start dropping the price down to $95,000, $93,000, all the way down to $90,000. Now, the lower price of $90,000 might cause a sudden influx of interest from buyers, who will then quickly bid the price up back to well over $100,000 and beyond sort of where the auction initially started. Now let's say the prices keep going higher and higher to maybe $110,000, $115,000, and eventually $120,000. At this point, we're well over the initial price of $100,000, and interest from buyers starts to wane, as the price is just too expensive for most participants. We then may notice the auctioneer starting to use filler phrases and kind of slow down his pace of speech because he's just not seeing that many bids anymore. These are all classic signs that it's probably late in the auction process. However, the most important thing to note is that the auctioneer can technically ask for any price. What matters isn't what price he's asking for, but rather how many people are willing to pay at that price. So With this kind of understanding of a one-way auction, now let's go back to the two-way auction process. Before the markets traded primarily electronically, traders and market makers would gather on the exchange floor, otherwise known as the pit, and trade in a two-way auction known as open outcry. So you would have, buyers in the pit, sellers in the pit, market makers in the pit, and buyers would be quoting a bid, sellers would be quoting an ask, and you would sort of have this really chaotic kind of auction going on for different instruments, whether it's equities, futures, or options. So with this in mind, we can apply the principles about an auction process to really understand the market. And that's going to bring us to market profile, the subject of today's lecture. So what is market profile? You may have heard this term used. It's really popular amongst a lot of order flow traders. And really, all that market profile is trying to do is record the continuous two-way auction process of the market. Embedded in the market profile is very important information about the market structure. And the market profile can help us interpret this market structure to develop a trading edge. So there's a couple of core principles of the market profile that I want you to really remember. And if you're going to take anything away from today's lecture, I would say these three things are some of the most important ideas. The first is that price is simply an advertising mechanism. Think back to that auction house example. Any price can be advertised, whether or not there is a lot of interest. Market makers are going to be quoting a bid and an ask, but what matters is, like we said before, are people willing to transact at those prices? The second point is that time is the regulator of these opportunities to transact at a given price. And the third idea is going to be that volume is the measurement of the success or failure of these opportunities. So a price being advertised at a certain time represents an opportunity. And if there's a lot of volume and trade being done at that point in time, at that price, that represents a price where there's a lot of interest from buyers and sellers to transact at, and simply vice versa. If there's not a lot of volume being done, if there's not a lot of time spent at a given price, then we can sort of say that, hey, maybe this is a price that one side really isn't interested in transacting at today. So before we go further, let's kind of talk just briefly about the history of the market profile. So Peter Stahlmeier was a trader on the exchange floor back in the 1980s who invented the market profile. And then there's Jim Dalton, who's another very important person who popularized this idea. You may hear their names as you kind of read up a little bit more on market profile, and you might even come across their books on the subject. These are really great introductory materials to study, and I'd strongly recommend that if you have the opportunity, you go through them in great detail. So a market profile chart consists of a bunch of things called time price opportunities, otherwise known as TPOs. So the whole idea behind a TPO is that if we go back to our candlestick chart, we have time on the x-axis and then price on the y-axis, and we're looking at price over time. Now I'm going to say, let's invert the chart to have price on the x-axis and time on the y-axis. If price trades at a certain value, let's record this with a letter. So each of these letters is called a time price opportunity, or TPO. Each letter is going to represent a 30-minute period. So if a certain price is traded between 9:30 a.m. Eastern and 10 a.m. Eastern, we're going to record a letter A on that price. If it's traded between 10 a.m. Eastern and 10:30 a.m. Eastern, then we'll record a letter B there, and so on and so forth for the rest of the market session. Now, if the same price is traded in multiple 30-minute periods, then we will stack the different letters on top of each other. And this is going to form a histogram or a distribution of the prices traded throughout the day. So if we look at this market profile chart that's going to be developing on the slide here, you can see that the market opened at 39.41 3/4. So we're going to record a letter A there. Then, as A period progresses, we're going to record A's every price that the market trades. So now we ticked up to 39.42. We're going to record an A there. And then as we move a little bit higher, we're going to record A's at each and every one of those prices. Now, if we repeated this process for the rest of the market session, we would end up with this. And this is essentially our market profile chart, which is a distribution of TPOs for a given market session. Now, usually when you'll see a market profile chart, it'll be rotated 90 degrees on its side. So you'll have the prices kind of vertically, and then the TPOs stacked kind of going in towards the middle of your chart. And that's typically how the market profile is represented, just because it's a little bit easier to display the information that way. Now let's go over a couple of important sort of aspects of the market profile. So the first is going to be the point of control. The point of control is the price during the market session, which has the most TPOs. So in this case, obviously, it's 39.42.5, because that has the most TPOs compared to any other price that day. We can sort of think of the point of control as the fairest price to transact at for both buyers and sellers, since obviously there was a lot of interest because we clearly traded that price throughout multiple periods. So you can almost think of the point of control as sort of a magnet that prices that maybe veer a little bit too far away from the point of control to less fair prices may tend to kind of come back and stick to that point of control. And we can see that happen during this market session today, given that we traded this price during almost every period. So the next concept about the market profile is going to be the value area. So the value area represents roughly 70% of the day's TPOs. We arrive at this number 70% because if you think about a normal distribution, one standard deviation out from the mean of a normal distribution on either side is very roughly about 68% of the area under the curve. So we're just going to round it up and say it's about 70%. So to calculate the value area, what you're going to do is you're going to start at the point of control and then move out one price, either left or right, based on which adjacent price has the most TPOs. We're then just going to keep repeating this process algorithmically until we've covered at least 70% of the day's TPOs. The value area represents the region in the market where the most participants can find fair value. In a mean reverting market, we expect price to generally not leave the value area or return pretty quickly to it if it happens to leave it briefly. So the value area high is the highest price in the value area. And in this case, it's going to be 39.43 3/4. Similarly, value area low is just going to be the lowest price of the value area. In this case, it's 39.41.5. So now let's move on to another really important idea about market structure, and that's going to be the distinction between price versus value. Now, I'm just going to emphasize this again. We do not care solely about price. Remember that price is simply an advertising mechanism, and it can be misleading. However, we want to pay attention to value. You should always be asking yourself when you look at the market structure, what is value doing? Where does the market want to auction, and where doesn't it want to auction? For example, is today's value area inside yesterday's? That may indicate a passive balancing session. Is the value area completely outside of yesterday's? This may indicate an aggressive trending market. Oops. Focusing on value can help us avoid chop in the market and instead understand how different participants might be viewing the market. So let's go to a concrete example of a trade that we could take based on our understanding of the distinction between price and value. Like I said in the previous slide, generally we want to look at what value is doing and then see if price is following along. For example, on this day, you can see that the market opened higher and the value area was overlapping higher than the previous day for the session. Now, the chart on the left-hand side is going to be the same TPO chart that we were looking at. On the right-hand side, what I've done is expanded the periods individually so you can sort of see how the market traded throughout the day. This is pretty much the exact same thing as a 30-minute candle, just without the wicks. So we established that the market opened higher and that value was overlapping higher relative to the previous day. However, if we look at the right-hand chart later in the day, such as in J period and K period, you can see price migrate outside of the value area and actually go lower as the market kind of sells off a little bit. Now, this is an important distinction to make. We said value was overlapping higher, but price is now going lower. This is a good indication that the market is probably getting too short into the end of the day, and these short-term sellers are likely going to have to liquidate their positions. And that's exactly what happened. As you can see, the market traded back up into value and closed much higher. This isn't a crazy complicated trade. It's a very simple trade that just took advantage of the understanding that although price was trending down, value was migrating higher. And in these situations, we almost always want to follow value. Let's talk a little bit about market participants. When we're looking at market structure, we want to get a sense as best we can of who is participating in the market and what their intentions are or how they might react in certain situations. So let's first start off with strong-handed traders. Strong-handed traders are usually longer time frame players who are well capitalized and not emotional. They're generally willing to hold positions for multiple sessions and aren't worried about a little bit of drawdown. Examples of such traders can include large institutions like investment banks and pension funds. When they want to buy, they're going to buy, and they're not going to be worried if the market goes a little bit lower because they're going to be just, sending such large amounts of flows into the market and accumulating a lot of inventory for a much longer time frame. On the other hand, weak-handed traders are shorter time frame participants who are not well capitalized and easily scared out of positions. They will generally pay close attention and react to visual references, such as the previous day's low. Examples of such traders may include day traders at prop funds who like to start and end the day flat. Oops, sorry. So now that we have a better understanding of price, a better understanding of value, and a little bit more information about different types of market participants, let's go into some more details about the market profile. Now, remember that this is the same market profile as before. We've just flipped it on its side and are going to be looking at it that way. So on a profile, a tail is when the high or low has an excess of lone TPOs. Tails indicate high interest from one side and low interest from the other. This is very much in contrast to the point of control, which has a good amount of interest from both sides, and you see a lot of two-way trade. Whereas with tails, you're not quite going to see this. So if we look at the example profile, you can see that buyers stepped in very quickly during C period when prices fell out of value and were very eager to quickly scoop up any of that inventory that was, you can sort of think of it as inventory available at a discount for them. So they were eager to quickly buy all of this inventory. Sellers weren't really that interested in aggressively selling these lower prices, and the market transitioned nicely back into value. Similar to the idea of tails is something that we call single prints. Single prints are a sequence of lone TPOs, kind of like tails, but instead of being at the higher or lows of the profile, they're going to be in the middle of the profile, meaning that there are other TPOs above and below them. Single prints usually signify emotional buying or selling. They tend to serve as important supports or resistances in the market later on. So in this example, you can see that in J period, weak-handed shorts from earlier in the day were forced to liquidate because the market made a new intraday high. Notice how these traders were paying attention to a visual reference, the current high of day. And when this reference was broken, an influx of emotional buying created single prints on the profile that then allowed the market to close a little bit higher into the end of the day. Typically on the profiles that we share, you'll sometimes see this pink line which denotes the start of single prints. So it's nice and easy for us to see when we're looking at multiple profiles over time. So now that we know a little bit more about kind of how TPOs can tell us a little bit about market structure, let's talk about a couple of advanced profile concepts. So first, let's go over balance days. You may have heard this phrase a lot when people saying, oh, the market's just balancing, don't worry about today, it's just a balance day. What does that mean? Well, balance days are really what they sound like, a market profile with a relatively even distribution between the highs and the lows, much like a normal bell curve. Usually these days are kind of rotational and are very technical in nature. A lot of times we'll find that there'll be nice, predictable reactions to very visual reference areas. Now, an interesting thing about balancing markets is that the longer a market stays in balance, meaning if you have multiple balance days back to back to back, the market's kind of building up energy. It's a dynamic system, right? And the more energy the market builds up, typically that means that at some point it's going to break out of balance with a strong directional move. You can almost imagine a very tightly coiled spring ready to just release a bunch of energy. Now, in contrast to balancing days, which I would say usually occur about 80% of the time the market's balancing, but the other 20 or so percent of the time, it's trending. So a lot of us are probably familiar with trend days. We've seen a lot of them lately. But a trend day is when the market decides to seek new value, usually after a period of one or more balance days. Usually, trend days are the result of new aggressive participants entering the market or some sort of news that changes the investor's perception of value. CPI, FOMC meetings, these sorts of news events have lately really caused the market to trend quite strongly because there's new information entering the market, and therefore our understanding of value changes. Maybe we thought value is too low relative to what this new information is telling us. So the market will trend upward, or vice versa on a downtrend. So let's look at an example of a trend day on the right. So we had the market sort of balancing for about 4 days or so in early January. And then on the 10th, or sorry, this was in early November, excuse me. And then on November 10th, the market in A period opened well outside of a prior 4-day balance. Now, when a market does that, it doesn't necessarily mean that we have to jump into the trade right away. But what the market did was that it came down and tested the top of the previous balance region. You can sort of see the low in A period and the top of the previous 4-day balance, kind of denoted by that white line there at about 39.02 and a quarter. So it came down and tested the top of this previous balance region. Sellers were unable to break through this very visual reference. And that is confirmation that the trade remains to the upside. So in such situations, we'll probably want to take our chances and kind of go with value, go with the trend that's migrating upward, even though prices are higher than the previous 4 days. Because again, it's not about value, it's about price. So we'll want to probably, more often than not, take our chances and go long with the trend. And as you can see, that's exactly what happened. The market quickly turned around and ended up closing much, much higher by the end of the day. Now, if you're in the TradeAtEase Discord, you probably heard us talk a little bit about B profiles. What's a B profile? A B profile is basically a profile where we have a string of downwardly trending TPOs that then leads into a balance area that forms at the lows of the day. And when you kind of look at this market profile chart, it very much looks like a lowercase b, which is why we call it a B profile. So what does a B profile mean? Why is it important? Well, a B profile typically represents weak-handed buyers liquidating emotionally into lower prices. For example, if a previous reference area was broken, they might get scared out of their positions, get very concerned, and start selling, and that leads to sort of a cascade of liquidations. However, this cascade of liquidations then a lot of times leads to an opportunity for patient, strong-handed buyers to step in and take advantage of these lower prices. And a lot of times you'll see that the distribution at the bottom of the P profile indicates an area where these longer time frame participants are very interested in buying and accumulating inventory. A lot of times you'll see this type of a profile signify the end of a sell-off, because we finally reached an area where we flushed out the weak-handed players and gotten to prices attractive enough for these longer time frame buyers to start stepping in and accumulating lots and lots of inventory. And then usually, within a day or maybe a couple days later, you'll see the market just absolutely rip. And this is really, it kind of all starts with this B profile right here. So sort of the cousin of the B profile is the P-shaped profile. A P-shaped profile is a string of TPOs trending upward that then leads into a balance area at the highs, forming a P shape. A P profile typically represents weak-handed shorts getting trapped, causing an emotional short covering rally that stops when patient sellers decide to step in and take advantage of the higher prices. If this sounds familiar to you, it's because this is very much the sort of contrary scenario to what we just discussed before with the B profile, except this time we have patient sellers coming in, taking advantage of emotional buyers kind of emotional sellers getting out of their positions. So this sort of upper balance area may indicate a region where longer time frame participants are interested in selling. And a lot of times this can signify the end of an extended market rally. I'd really encourage you to kind of, if you are able to access a market profile chart, to go through it and look at kind of the different B and P shapes that pop up. And I believe a lot of times you'll notice that right before a major sell-off or right before a major rally, you'll usually see one of these profile shapes, a B or a P, kind of put a stop to the trend one way and ignite the trend the other way. So you might be asking, yeah, this sounds great. I get the different profile shapes. I understand TPOs. I understand value versus price. How the heck do I make money off of this? How do I use it to trade? Well, there's a lot of different ways that you can do that. So let's go over one example pretty recently that we actually had covered live in the TradeAtEase Discord during our morning voice session. This is a trade that we called out live. Bullish Richard, for those of you who are familiar, gave a really excellent call out at the low of the day here. And let's kind of go over the insight behind how he did it. So on January 12th, the market opened outside the previous day's value. Overnight inventory was net long and corrected into the open, as is typical of kind of an opening auction. However, the fact that the market opened and was auctioning outside of value tells us that there's a good chance that value is likely overlapping higher, and certainly value is very unlikely to overlap lower in these cases. Now in A period, the market trades lower and tests the previous day's value area low. Now, recall our previous discussion about value versus price. We know today value is likely to move higher, but price has gone lower. Sound familiar? This represents a great buying opportunity to trap weak-handed sellers at a very visual reference area, the previous day's value area low. And buyers were able to swoop in and do just that, taking the market much higher. So we, that day during our morning live session, called out that the market was likely to reverse at about 39.58, and you can see that that's exactly what it did. That was the low in A period and the low of the day, and then the rest of the day we saw value kind of migrate and overlap higher relative to the previous day. So a common question that we get asked is, how do I look at the market profile? What platforms can I use? So you have a couple of different options. Sierra Charts is Tay's favorite option for charting the market profile. It can seem a little complicated at first and the software might look a little bit clunky, but once you get the hang of it, you'll realize it's a very, very powerful tool. The downside is that Sierra's only available on Windows. If you're on a Mac, you can use NinjaTrader or MotiveWave. These are two other platforms that are able to chart market profile as well. They seem to be popular among some members of the community, but I personally don't have much experience with either of them. Lastly, you might also be able to find scripts kind of floating around the internet on Thinkorswim or TradingView that can plot the market profile. I've taken a look at these. These scripts are usually not perfect, and there's sometimes errors in kind of the way that they plot the TPOs. But it might be of interest to some folks if you're really, really familiar with these two platforms and kind of want to stick to these. So that's all for today, guys. You know, we covered a lot of information, and I know it's probably a lot to digest if you're new to kind of auction theory and the market profile. So I'd encourage you to, take some notes, digest it, and then try to look back at some previous market sessions and see if you can kind of apply these concepts in your analysis, and then start to do that moving forward as well as you create your plans going into the future. Again, if you want to go ahead and join us at TradeAtEase, we do morning voice sessions every day where we break down the market profile as part of our daily plan, plot out key levels, and then give kind of live trade opportunities that we see. We also do alerts on text, and then recaps at the end of every market session, kind of breaking down the important aspects of our plan, the important levels, and really we'll apply a lot of these concepts. So if you kind of want to see more of these concepts applied in action, like that last example I showed you, I definitely encourage you to sign up. Again, there's a coupon for 33% off in the video description. Go ahead, click the link, sign up, and we'll see you there. Now, for those of you who are members, we're going to be doing a dedicated Q&A for our TradeAtEase members in the TradeAtEase Discord. So I'm going to sign off of this stream. Please join us there. And yeah, thank you very much for coming and taking some time on your Sunday to study the market profile with us. Good luck to you. For those of you in the States, happy MLK Day, and we'll talk to you soon.